So what are the tax benefits when it comes to the cash value of a whole life insurance policy? Because when we ask people, why do you purchase whole life insurance, or why do you put boatloads of money here, again, for the cash value, they express what? It's a safe place I can put money that I can use like a personal line of credit, and it has a nice tax benefit. So what are the tax benefits? Again, of the cash value piece, not the death benefit, because the death benefit is paid out income tax-free with any type of life insurance policy. Well, the tax benefit regarding the cash value is this. If you do things right, you can access that cash value tax-free, and it's really, really easy to do. So when we look at a whole life insurance policy that's set up properly, where the growth is maximized, the net growth rate on a policy is usually going to fall somewhere between 3 to 5%. The term you'll see on an illustration with a life insurance company will be the internal rate of return. But again, if you set it up correctly, especially if it's with one of the 4 major mutual companies, we could see it produce somewhere between 3 to 5%. Now remember, this is all without any risk as well, going back to the safety of the cash value. Here's what we hear sometimes around this, and we'll loop this back to the tax benefit too. When someone's looking at whole life insurance, if they have done well with other assets, other investments, they say, okay, 3 to 5%, that doesn't really excite me because I can earn 7 to 8% elsewhere with whatever else I'm doing, the market, real estate, their business, whatever. So pretend this is you. You can earn 7 to 8% elsewhere. You're shown a whole life insurance policy. You see the safety, okay, that's nice. You see the liquidity, how you can use it as a personal line of credit. Okay, that's nice, but that's still a big gap there, especially when you look at compounding over a long period of time. Would you do it? It can be hard for a lot. But what about this? If you can earn 7 to 8% elsewhere, and assuming that's a taxable account where you have to pay taxes, what are you left with after taxes? Meaning you have to pay a certain dollar amount in taxes, so we would want to be fair and deduct that from the return of the other place we are putting money. So afterwards, what am I left over with? Am I left over with 4%, 5%? It would depend on your tax bracket. Now, here's what I'll also say about this, is people we work with will do both. While whole life insurance is what our company specializes in, I do not believe that anyone should abandon other strategies and put everything they have in whole life insurance to maximize the cash value. People we work with, especially those that are most successful, do both, where they've got their money in multiple areas. They own a business, they're putting in real estate, they've got some in the market, they've got retirement accounts, they've got life insurance, they've got a little bit or a lot of everything. But we do see that quite a bit. Back to the question though. So if you can earn 7 to 8% elsewhere, what are you left with after taxes? Let's go through an exercise on this, and we're going to use the same policy we've looked at thus far. Remember this guy? So this is the 55-year-old individual funding a lump sum of $1 million over 4 years. There's the cash value, there's the death benefit, and what we've got here is the cash value growth, that's the yearly growth in yellow, and then the total gain highlighted in blue. Let's look at the same thing, but instead of looking at growth in dollars, we'll look at it in terms of rates. So what we'll do here we go. Same exact policy. Annual IRR. IRR represents internal rate of return. This is just the yearly growth rate, the yearly rate of return when we look at it. Meaning, if I look at year 5, where I pay in nothing, my cash value in year 4 was what? $990,000. I pay nothing in, the cash value grows to $1,032,000. If I were to punch that into a calculator and see what the return was, I would come out with about 4.17%. So that's the performance of the life insurance policy. And this is based on a current illustration. As time passes, we would track the actual results of this. But again, this is just based on a current illustration. To the right, we've got the taxable equivalent. This answers that question. If I can earn 7% elsewhere, what would I be left over with after tax? It does depend on my tax rate or my tax bracket. Here, we're assuming a tax rate of 30%. And we can change this too, but let's keep it at 30%. And let's look at year 10. This is pretty simple. You know what? Let's look at year 11. He's 65 years old, and our return is very close to a round number in the policy, 5.03%. You know what? Scratch that. Let's look down here. Try and keep it as simple as possible. All right. So the policy grew by 5% that year, 5.00%. The taxable equivalent is 7.15%. What does that mean? Well, that means if you're earning 7.15% in a taxable account and your tax rate is 30%, after you pay taxes, you'd be left over with 5%. That's what that taxable equivalent means. Now, if you are in a higher or lower tax bracket, you're going to see those numbers change. So let's assume we are in a lower tax bracket, or a tax rate is only 20%. What happens? Well, looking at same year here, where the growth rate was 5%, the taxable equivalent is not 7.15% anymore. 6.25%. What if I go up to the highest tax rate, 40%? What happens here? Now all of a sudden, it's at 8.34%. So you'll see a lot of people who are in high tax rates or tax brackets attracted to cash value life insurance. We talk a lot about how the wealthy and how corporations use whole life insurance. You've got the three reasons why: the safety, liquidity, and then the tax benefit. The tax benefit does become more and more appealing as I'm in a higher tax rate because I've got to pay more taxes on whatever else I'm doing. Whereas with this, I don't have to worry about it. If I do things right, because you can mess up a life insurance policy and trigger taxes. It's very easy to prevent. We've got other videos that go through that, but I always like to mention that because it's not automatically tax-free no matter what. We do have to know the very basics, such as preventing a MEC and not lapsing it with a gain on it. But when you combine the fact that the policy is going to produce somewhere between 3 to 5%, that I can access it like that personal line of credit. That 3 to 5% is also safe. I know no matter what happens, it's going to keep going up. And also the tax-free piece. Adding those three together is where people are attracted to the cash value benefit. And again, they're often doing other things on top of that. So I'm not simply putting all of my money into the policy and abandoning everything else. No, I've got this as a part of my tool belt that I can use as the years continue to pass for whatever I want to do with it. So I do hope that this video was helpful. Do let us know your thoughts and if you have any questions at all. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.